Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is CDW Corporation, ticker CDW. Over the next few minutes, I'll discuss both my thoughts on the valuation of this company and its business quality. Let's dive right on in. First up, we see the market cap is $21 billion and the enterprise value is $27 billion, so we can see about $6 billion of leverage on this business, and that leverage is probably going to affect its returns on capital. So this is operating in the electronic equipment, instruments, and components industry. If we look at the business description here, we can see they provide IT solutions in the US, UK, and Canada. Gives us a little bit of a framing of where they are, understand a little bit about the culture. Operates through three segments: corporate, small business, and public. Discrete hardware, software, products, and services. Integrated products include notebooks, mobile devices, video monitors, enterprise storage. So they're providing a lot of IT services, government, education, healthcare consumers, and a lot of business customers. So that's good to know about what they're doing. Return on invested capital. So it's interesting. This graph is actually really hard to read due to what happened here in 2008. But it looks over the last 20 years, they have been profitable for 17 of the last 20 years. Now, I really like to see 19 or 20. One or year of losses or no year of losses is ideal. Now, what we're seeing here is they basically lost a lot of money in the 2008 recession. They still lost money in 2009 during the recession, and they barely recovered to only basically break even, but losing money in 2010. So that's somewhat forgivable. We just need to understand with this business that they are going to be unprofitable in major recessions, but profitable during normal times. Now, these return on invested capital numbers, if we exclude 2008, 2009, and 2010, what do we see? Well, from 2001 to 2011, so from 2001 to 2006, you see 20% plus returns on invested capital. Those are really, really good numbers. Now, starting in 2011, if we again exclude these 3 years, we see you're basically barely making money in 2011, and you're slowly recovering back to normal since then. And it takes till 2017 to start making double-digit returns on invested capital again, 12% in 2017, 15%, 16, 14. So since 2017, this has been actually a really, really good business. And if you include, 2015 and even 2014, 6%, especially with the leverage on this business, is probably still really, really good. So they've been steadily recovering and getting better over the last decade. You really like to see that, actually. And the stability here is actually very, very strong and suggests a really high quality business. But 2008 was clearly bad. I do wonder if there's a temporary write-down here that makes this look worse than it is. You would have to really understand how much of their profitable times was wiped out during this recession. Otherwise, looking like a high quality business so far. 10-year median return, you see return on assets 6.9%. Return on equity of 58% is amazing. 11% in return on invested capital. All these numbers are very quality numbers, looking very good. Now, the PE of 21 is quite high. It could be justifiable with especially with these growth rates we're seeing. So you can certainly justify a PE of 21. I like to buy things at a PE of 15. If they're extremely high quality with very strong growth, paying up to about a PE of 20 seems reasonable. So you're right there. You're just a little bit on the overvalued side, but it might be very good business. Now, the revenue growth is really interesting. They've turned 8% revenue growth and 8% asset growth into a 15% free cash flow growth and a 50% EPS growth. Now, what I'm going to want to study is, have they been doing buybacks to boost this? What have they been doing to boost this? But they've clearly been making good progress on their numbers here. All of this is actually with really, really low margins, so it's going to be a high turnover business, which is why any slowdown could really hit them hard if they have to do any discounting, because you can see that they have really low EBIT margins. But that's not a problem as long as you're turning your assets quickly enough, which is clearly what they're doing with these returns. So what do we see when we look at this? This is what 50% EPS growth means. You turn 82 cents per share in EPS growth to $7 EPS growth in 2021. That's looking really, really positive. Now, if we compare that $7 in EPS to, that 158, you're paying basically this 21 multiple on peak earnings. So you have to be a little careful with that. You're going to have to definitely continue that EPS growth strongly over time in order to make the best of it. But it's been very, very strong numbers. I mean, this revenue growth, 8%, you're seeing a lot of dropping to the bottom line of these profit numbers, when you're tripling your operating profit, all that's really, really good. So you basically doubled your revenue, tripled your operating profit. That's good operating leverage. That's helping you out a lot. If you're enjoying this video so far, please hit that like button at the bottom. Don't forget to subscribe. Your subscriptions help me to grow the channel. It's really important for me that you subscribe. Hit that like button on every video if you're enjoying the work. That tells the YouTube algorithm that this is a great channel, that this is a good video. So I really appreciate that. So let's look at the income statement. The income statement is interesting here. I want to see the shares outstanding. So you do see some share buybacks, but it's not a straight line. So you increase shares outstanding for a few years from 2012 to 2015, and then they've been steadily buying back since 2015. So I like what I see there. Again, everything looks a lot better on this business since 2015. So I'm okay with that over a short-term period, but you really don't want to see that in the future. So you need to understand, if you invest in this business, are they going to repeat the period from 2008 to 2014, or was that a one-time aberration? You're going to want to spend some time studying the history of this business because it's a very different economic profile when you do so. Let's go to the balance sheet. Let's see. Now, what's really interesting here is they're making profits. So actually, let's go back to the income statement to show this. So you have an operating profit every year for a decade. You're making net income every year for a decade. But when you go to the balance sheet, there's basically no retained earnings. So you have negative retained earnings, negative retained earnings, negative retained earnings. They're not needing to retain any earnings in order to run this business, and they're operating at very, very low on equity. So basically the entire business is being funded with debt, which is what you're going to see. So you see this long-term debt is $6.7 billion here. Your PP&E is 351, goodwill is 4.3 billion, intangibles 1.6. So basically you have, long-term assets of just $600 million, and you combine that with, current assets of 6.4 billion, and then that adds up to the long-term debt. So they're offsetting their entire business with long-term debt. There's no equity needed to run this business, which is why you're getting those extremely high return on equity numbers, because it's highly, highly leveraged. That's going to be very good if things work out for you, because that means they're able to return all their money in dividends and buybacks, which is what we should see here when we look. So again, you issued some common shares in 2013. We saw that already, and they're issuing debt pretty constantly. Now, they are paying some dividends each and every year, at least since 2013. It's been growing pretty steadily, and they are buying back stock, a lot more stock buybacks than there are dividends, and that's pretty stable. What you can see that's interesting is they're essentially buying back, they're putting all their cash flow into buybacks and dividends. They're completely offsetting all of their income. To do that, there's very little money spent on PP&E. There is some for an acquisition here, but for the most part, they're funding their entire business with debt for any expansion, and they're using all their money to be paid back to shareholders. That's actually very attractive for shareholders. So this is a really interesting business. I want to know more about it. For me, it's going to probably go on my watch list, because what I like to see here is that clear stability. They're able to earn these double-digit return on invested capital. They're maximizing their return on equity, and they're using this growth rate to a maximum advantage. So I would look into this business further. Before I invest, I want to understand the 2008-2009 period. Is that repeatable, or is these long periods of stability what I should expect? So if you enjoyed this video, please hit that like button. Don't forget to subscribe. I'll be working through every company in the S&P 500, and you can look at my whole past history of working through them in the playlist that is here. Thank you for listening, and until next time, stop paying fees, start building wealth.